heard the term FinTech. But what is FinTech? And how does it relate to artificial intelligence, blockchain, cryptocurrencies, and all of the other disruptions occurring in the financial field? In this course, we'll learn the answer to those questions and more. I'll help you understand how you can start applying AI through tools like Excel, value cryptocurrencies using financial models, and build your own robo-advising tool to make investment recommendations, and much more. I'm Dr. Michael McDonald. I'm a professor of finance, a Wall Street veteran, and a frequent industry consultant. If you're ready to learn how to use the innovations of FinTech to make yourself a more informed and successful employee or investor, then let's get started. Now, the term FinTech doesn't have a precise definition, but in general it refers to a variety of areas that are emerging and growing very rapidly. These include things like blockchain, automated investment advisory services, more commonly called robo-advising, online lending, AI, crowdfunding, and a number of other areas. All of these areas have the potential to disrupt traditional finance, and for that reason, there's a lot of focus and a lot of interest in this space. Now, FinTech is having a tremendous impact on many areas of the financial landscape. In particular, when we think about things like investment advisory services or the trading of stocks and post-trade settlement activities, FinTech is changing the landscape there. When we think about blockchain, it has the potential to make trade settlements much faster and cheaper. Online marketplace lending is changing the way people borrow money and the way they start businesses. Now, the issue with a lot of this is that our regulatory environment is built for the old system. The SEC rules were built around the system that developed over the last century. That's true both in the US and abroad. And so different regulators around the world are taking a different approach to these new and emerging FinTech issues. I don't know what the regulations are going to look like in many of these FinTech areas a decade from now. Nobody does. And that's what's so interesting, but also so challenging about working in the FinTech space. For you, let's talk about how it fits into the broader technological revolution that's going on and some of the areas of finance that might be particularly impacted. So there's a lot of different new technologies that are coming of age right now, right? This is a graph that comes from a study done by Ernst & Young, and they identified a series of important technologies. We have the black dotted line, the cloud. We have process and service externalization. We have robotic process automation. We have advanced analytics, digital transformation, artificial intelligence in red, smart contracts, that's blockchain and things like that, in turquoise, the Internet of Things in the gray, and then blockchain in, let's call it the silver or the light gray. Now, what they're showing is essentially kind of how these trends are changing the landscape of finance, or how they're expected to change the landscape of finance moving forward. And we have on the left side, right, the near-term impact over the next few years, the medium-term impact over, say, the 3 to 5 year time period, and then the long-term impact beyond 5 years. And we can see that basically there's certain technologies that are having a big impact right now, stuff like the cloud, where there's a lot of migration by finance companies and FinTech firms where they're putting their data in the cloud. That's going to taper off over time. Comparatively speaking, something like AI is not having as big an immediate impact, but the medium-term impact there is potentially huge. It's one of the most impactful technologies alongside blockchain over the medium and long run. Now, there's a series of applications that we can see AI being used for, particularly this new version of AI that we call generative AI. So this is from Morgan Stanley, and they did a research report recently looking at various investments firms and finance firms, and they were looking at different areas where Gen AI could be impactful. Right? And so we see this is going to have an impact on finance firms in everything from the sales and client services area to products, investments and research, and then mid and back office. And we can see a slew of different ideas that they had where Gen AI might have a big impact, right? Everything from personalizing the customer journey, that is helping to make customers more comfortable when they're first signing up, to drafting customized research reports over time, to things like, as an example, code generation for IT on the back end, or doing summaries and regulatory documents, right, from a risk and compliance standpoint. We can see this impacting the research process. We could see it impacting portfolio management. So there's many different applications over the medium term for this. Now, lest this seem like pie in the sky, you don't have to look very far to start to see the embryonic beginnings of this. Let's take a look at an example. So I'm here in ChatGPT, and we're looking at just the basic free version, Chat 3.5. We could switch over to the paid version, but just to kind of keep things simple, I'm going to show you what you can actually do using free tools right now. So I've asked it to construct a sample portfolio for a 35-year-old man earning $100,000 per year. You could try this. Of course, you'll get a slight variation on it, but it says, okay, here's the 35-year-old, and here's kind of the key buckets that they should be putting their money into. Emergency fund, retirement accounts, 401k and IRA, stocks, bonds, real estate, things like that, right? And they give some specifics too. We should be aiming for 10 to 15% of annual income in our 401k or the equivalent thereof, like a 403b, right? We should be thinking about putting money into real estate investment trusts, maybe around 5 to 10% of the portfolio. Maybe look at some alternative assets for, say, 5 to 10% in different areas, things like that. Okay, easy enough. Now I'm going to give it a little bit more specific information. Let's say that this guy has 2 kids, ages 3 to 7. He wants to save for their future college needs. He's married, his wife's not working. What adjustments would you make? Okay, well, given this, it's going to go through and outline how they change the basic financial plan in terms of increasing the emergency fund, for example, still continuing to contribute to that retirement account, but maybe those retirement contributions need to be a little bit less given that they'll need to save for the kids' college, right? So we're adding that college savings in here. We've still got our stock and bond portfolio, but now we're going to layer in some life insurance as well, right? So it goes through and makes those adjustments. Now, what happens if we say there's a nest egg of $200,000 for this couple currently, and they live in, say, a state with a medium level of income tax, 5%? What kind of changes should we make, and what should be the specific breakout between stocks and bonds and things like that? Well, again, ChatGPT is going to go through and make adjustments to the plan based on that. And the bottom line is it's going to say, okay, put about 65% into stocks and about 35% into bonds for your retirement assets. All right, fair enough. That seems like, broadly speaking, a reasonable portfolio, right? Just given the age rule and things like that. In other words, the allocation to bonds is often said that should be about the same thing as your age, right? And there's different algorithmic trading. The reality is the financial industry is evolving. Computers, ever since the 90s, have been playing a bigger and bigger role. Algorithmic trading, computer-driven trading, now makes up the large majority of trades. More than 90% of orders on the stock market are computer-driven by some estimates. So the reality is that that old trope about a human being a stock picker and making those trades, that's something that's relegated to the 80s. The new trader really is a computer, and the role for humans is in designing algorithms. Humans play a role in trading by telling computers what to do, what to look for. Now, algorithmic trading essentially comes in 2 different flavors: market making and data mining. Market making trades attempt to capitalize on the bid-ask spread. This is typically associated with like high frequency traders and things like that. Now, if you're not sure what the bid-ask spread is, I encourage you to check out my Understanding Capital Markets course here on LinkedIn Learning. The other type of trading is based on patterns in data. This is data mining. And what we're essentially doing is looking at patterns in stock prices and trying to capitalize on those. So we might look at correlations between different stocks, or correlations between stock prices and outside economic data, or a variety of other data sources we get our hands on. The nice thing about algorithmic trading is that the more data we feed into the computer, the more opportunities there are to make money. So algo trading is really one of the key applications no area of FinTech gets talked about more these days than blockchain. But what is blockchain? Well, the answer is that blockchain is really just a 21st century version of a very old tool, a ledger book. If you ever had one of those old accounting style ledgers, right, where you went through and you wrote one transaction or one item on each line, and you filled up a page for bookkeeping purposes, and then you flipped the page, blockchain fulfills essentially the same function. The blockchain is a distributed distributed secure log file. What that means is that we've got many different people that can access this ledger book. The ledger book is protected by a super secure username and password, and it contains a complete record of every transaction that is ever recorded on the blockchain. Now, blockchain was first popularized as kind of the behind-the-scenes tool for Bitcoin, but the reality is that these days it's grown far beyond that. Blockchain underlies virtually every digital currency out there. Everything from Bitcoin and Litecoin to Ether, Ripple, Monero, etc. But you don't have to be interested in digital currencies to see the value in blockchain. Even if you think that Bitcoin, as an example, is silly and it doesn't have a future, blockchain is still potentially very useful because blockchain enables any sort of asset transfer. So if you're buying a house, as an example, you have to go through and do things like a title search and a survey and a homeowner's inspection and everything else. And the process of closing on a house takes months because of that. Blockchain can speed that process up. Essentially, any asset transfer, from the electrical grid to stock and bond trading, could in principle be done on a blockchain. So blockchain, in essence, is similar to something like Wikipedia. People can write entries into first successful peer-to-peer digital currency. What that essentially means is that Bitcoin is nothing more than a series of letters and numbers on a computer screen. Now, that might not sound normal, right? How can a series of letters on a computer screen have any value? And yet, when you think about a green piece of paper out of your wallet, what is it that gives that value? It's not the fact that it's green, it's not the fact that it's a rectangle, or that it has a president on it. Instead, it's the fact that it has a sequence of letters and numbers in the corner, which tells the US government, hey, we printed this, and it's valid tender. Everything else is incidental. Bitcoin works the same way. The value of Bitcoin is solely driven by the acceptance from that community of users. Now, Bitcoin comes built in with an accounting system, the blockchain, which records all of the transactions that occur. Bitcoin also comes built in with its own set of auditors, or accountants, if you will. We call these guys miners. A lot of people think the purpose of miners is to generate new Bitcoins. That's not the purpose for the most part. Instead, the purpose of miners is to make sure that the system is working as intended and there's no counterfeiting of coins going on. Bitcoin is limited to a cap of about 21 million coins over time. Bitcoin is built around the three parts of blockchain. The private key cryptography, which protects the access of the user to their Bitcoin account, the distributed network, which records all the Bitcoin transactions, and then the mining, which audits those transactions. Bitcoin is deflationary, so as the number of users grows, the number of Bitcoins only grows at a slower and slower pace. Because of that, Bitcoin is divisible out to 8 decimal places, much further than the 2 decimal places associated with, say, the US dollar. The other attractive feature about Bitcoin is that there's minimal transaction fees. Anybody can transact over the Bitcoin blockchain at very little cost. And because there's no central authority behind it, Bitcoin is consensus-driven. Now, the downside of Bitcoin is that, again, there's no central authority, which means if someone steals your Bitcoin or cheats you in some fashion, there's no higher authority to appeal to. The government can't help you. Nobody can force the reversal of any Bitcoin transaction. There are transaction fees associated with Bitcoin, but they're kind of like tips. These transaction fees get paid out to the Bitcoin miner, and they're really a form of income in excess of mined coins. Those fees are voluntary. You don't have to pay the fees. But of course, if you go into a bar, the bartender doesn't have to serve you, right? They could serve everybody else in the bar ahead of you. You pay a tip in order to get the attention of the bartender. You pay a transaction So what's behind all the hype? Well, let's take a look at a common kind of problem and how 3 different AI systems would deal with it to better understand where the capabilities are today. So I've got 3 different AI tools open here. We've got Microsoft's Copilot. We've got ChatGPT from OpenAI, and of course there's a relationship between Microsoft and OpenAI, but these are separate tools. And then we've got Anthropic's Claude, okay? And we'll talk about each of these briefly in turn. But I've asked Copilot to do a fairly straightforward task for me. It's the kind of thing that we might assign to like an entry-level financial analyst or somebody like that. We want to come up with a sample budget using common-sized numbers for a restaurant. Okay, so this isn't getting super granular. We really just want to go kind of revenue, our expenses, what do the margins look like, and then maybe do like a COGS-based projection, right? Look at, as an example, how our cost of sales grows over time, maybe what our compounded annual growth rate is, and kind of how that affects operating margin. So Copilot starts out doing a pretty good job here, right? It says, sure, yeah, I'm going to create a budget for a restaurant, and it's going to give me kind of some details here. If we assume $500,000 in annual revenue, that's $10,000 a week. Okay, seems reasonable. COGS includes direct costs associated with producing the food and beverages. Common industry benchmark is 30 to 35%. All right, I don't know a lot about the restaurant business, but I mean, big picture, that seems like it might be reasonable. Remember, I haven't given it any information at all here, but 30, 35%. So if our COGS is 30%, estimated COGS on a dollar basis would be $150,000. That is 30% of 500. Then we've got our labor costs at 20 to 35% of revenue. So again, using 30%, that's 150 grand. Okay, seems reasonable, right? Maybe that's, 3, 4 full-time people, something like that, making anywhere from 30 to 50,000 a year, I guess. Seems big picture, like it's probably reasonable for a restaurant of this size, I guess. Operating expenses, rent, utilities, insurance, marketing, things like that, in the 20 to 30% range. So about $125,000 a year. Might be a little bit low, but it's probably in the right ballpark. I suppose it depends on where you are. Okay. So here's your profit margin. It says we're going to subtract off from revenue our COGS, our labor costs, and our operating expenses. So it gives us 500,000 minus 150, another 150, and 125, giving us 75,000. Okay. And then it's got our net profit margin. It says that's typically in the 5-10% range. So then I ask it to put it into a table for me. And so it says, okay, well, here we go. Here's my percentage of revenue, right? And it's got my profit down here at 75,000. Now notice it also says net profit margin of 40,000. So it's got profit of 75, then net profit of 40. It's not really clear what the difference is unless we're including taxes or something like that, but it didn't really say anything about that. So we might conclude that Copilot is either skipped a step or is really kind of doing 2 separate calculations. But I'm going to keep going, and we'll say, let's do a 5-year projection based on these numbers and assuming 8% top line growth. Okay, so it goes through, it's going to run through the calculations, and we put it into a table. Now you'll notice it compounds the revenue. It didn't make any assumptions or give me anything related to COGS, labor costs, operating expenses. Okay, so not really where I wanted to go. I wanted to kind of see what the whole projection looked like. But I'll tell it, let's assume COGS and labor grow 4 and 6% respectively, and then we'll see what we get. And it updates the table. But again, it won't update operating expenses. I'll assume that maybe those stay the same. Rent, oftentimes you're on a lease, so that might not vary very much. Let's see what we get. Okay, so it's going to populate operating expenses all the way down, goes through and calculates profitability. Now notice, it's been saying the net profit margin here is 8% all along. Well, if we look at the math, right, 75,000 in profit divided by 500,000 in revenue is not 8%, it's 15%. 75 divided by 500 is 15%. Okay, so it gets this first net profit margin wrong, but it gets the subsequent net profit margins correct, right? 100,000 divided by 540 is 18.5%. So this is kind of a perfect example of both the power of AI as well as the challenges it faces. In some respects, I like to compare AI today to like maybe a college intern. It's got some good capabilities and it can do useful things like putting this together, but realistically, it's probably going to make some mistakes if you start asking it to do much of anything that's even mildly complex, right? And so then you have to go through and you have to catch those mistakes and correct them. Does that mean it's useless? No. It still saves you time, but it can't be kind of set free on its own, as it were, right? Because there's a big inconsistency between how it's doing these calculations, right? We might argue that maybe in the net profit margin, there's some hidden costs they weren't talking about, like taxes. But certainly, if that's the case in year 1, it should be the case in year 2. There's an inconsistency here in how it's doing the calculation. Now, let's just look at what ChatGPT does. So ChatGPT, I give it exactly the same starting prompt I say, okay, well, let's get a sample budget using common size numbers for a restaurant. And it's going to go through and it gives me a little bit more granularity, kind of interestingly, right? Labor costs from kitchen staff's 25% of revenue, front of house staff is 20% of revenue. So notice that's a different number than we had on labor costs from Copilot. Right? And then it's going to go through and break out my operating expenses, administrative expenses, et cetera. And it's putting these all in as percentages. It hasn't given a dollar value. And then I wanted to put it into a table, and it's going to go through and kind of give me this type of a breakout. Now, again, I could go through and I could ask it to do some projections, maybe based on a hypothetical top line and then these percentages. And I could go through and ask it to modify these numbers over time as sales grow. But, it's a reasonable tool. Again, the same cautions apply as with Copilot. It's probably not going to give you exactly what you're looking for, and you'll probably have to go back and forth with it just a little bit, and you may have to catch some errors. Now, how about Claude? So Claude from Anthropic is kind of interesting, right? Claude is nice because Claude says it can deal with handwritten notes, and it can do some coding for you, and it can deal with kind of complex equations. So all that's great. Let's give it the same prompt here. I want a sample budget using common size numbers for a restaurant. Let's see what it comes up with, and we'll just do this in real time, right? So here we go, revenue. We have food sales, beverage sales, total revenue. And it's going to break out my operating expenses, right? And again, it's got my COGS is about 27% for food costs and beverage costs. So it gave me a little bit different breakout than, say, Copilot or ChatGPT did. But, Copilot had 30% as the COGS. We've got 27%, broadly reasonable. It's going to go through and break out my operating expenses and then some other expenses. And it gives me kind of an overall approach to how do I do some budgeting. And interestingly, it comes up with exactly the same net income. So I'm just going to give it one more go here, and I'm going to say, apply these numbers to a top line sales value of 500,000 and put it in a table form for me. And we'll see how Claude does with this. Okay. So here we go. It's got net income at 8%, $40,000. That seems correct. All right. Let's see. Let's do a projection over 5 years, assuming top line growth of 8% and reasonable estimates given that for cost growth across all categories. Again, in table form, please. And I don't have to add the please, it's software, but, it's just a habit. Now, notice I gave it the same top-line growth as we did for Copilot. And so we can compare kind of what these numbers look like, at least on the top line. We see at year 5, we get 680,000. Artificial intelligence is really just a part of the computer science discipline. It's a field in computer science focused on automating intelligent behavior. Now, of course, that definition's a little disconcerting, right? Because what exactly is intelligence? That's a tough question to answer. The reality is that we don't have a specific definition for intelligence, but certainly we'd like to see any kind of AI have flexible responses to different situations versus mechanical behavior, right? If the AI does exactly the same thing in every set of circumstances and it never adapts, we can't really call it AI. It's not intelligent. Moreover, AI has to be able to adapt to ambiguous or contradictory messages. This is particularly true when we think about natural language programming, right? A lot of times, anybody who's ever dealt with a customer in business understands that the customer will say, well, the most important thing to me is price, but the most important thing to me is also quality. Oh, and by the way, customer service is also the most important thing to me. AI has to be able to deal with those kinds of things, even just to do something like power a chatbot, right? So AI has a lot of different responsibilities placed on it. It has to be able to assess relative importance of different elements in any particular circumstance. For instance, quality versus price of a product. Right? If we're talking about paper clips, maybe price is the most important thing. If we're talking about heart implants, like a stent as an example, quality is probably a little more important there, right? Similarly, AI has to be able to look at a situation and then find similarities in it despite differences. So for instance, AI, if we're thinking about image processing, needs to be able to identify two different dogs in two different pictures, or two different cats, or things like that. We might have a dog under a tree in one circumstance and a dog in a living room in another. AI needs to be able to recognize the similarities in those different situations. At the same time, AI needs to be able to draw distinctions between situations despite similarities. We can't put all people together, for instance, under one bucket. We've got to be able to differentiate physical appearance between, say, me and you, so that the AI, the system, recognizes who it's talking to. When we think about something like facial recognition used in smartphones now to unlock those phones, the AI you might be familiar with. Excel is one such example. I'm in the 0202 begin Excel file. Now, what we've got here is just a short list of different companies based on their stock ticker symbols and a short list of countries. And the neat thing here is that Excel has recently implemented new features that allow us to pull data based on these particular data types. And that data is key for any AI applications we might want to use. So the first of these new data types is what's called stocks. As the name implies, we can take any ticker symbol and convert it into a stock data type and then pull data based on that. So for instance, I'll highlight the Apple cell and then click stocks. Now look what happened. Excel goes through and says, oh, I recognize this. We're looking for Apple. So I'll highlight the others and I'm going to do the same thing. And we see them all converted, except for our last one, Toyota Motors. Notice, again, this highlights one of the challenges with Excel and with AI in general. We sometimes run into confusion about particular data points. So I'm going to let Excel know that I'm interested in Toyota Motors. Now, I can pull data on any of these companies and their stocks by clicking this little symbol that you see, which says Insert Data. So I'm going to click on this particular tab. I'm going to highlight the whole row just to make it easy for us. Click Insert Data. And let's just pretend I'm interested in, say, the number of employees the firm has. I'll click that. Look what happens. Auto-populates. And we could name this Employees. Similarly, I could go through and I could pull data on, say, the headquarters for that company. Where's the firm located? And we get the address for each company. And I'll just label this HQ. In addition, we can do something similar with countries. Excel now has a new geography type that lets us pull data on geographic areas. So I've gone through, highlighted my 3 countries, and perhaps I'm interested in, say, the area of those countries, the geographic area. Always to go through and examine that data. And this is where AI can be very helpful. Let me show you how it's been done traditionally. So assuming that I had my data on, say, economic variables already put into Excel, and in columns B and C, I've got the U.S. Federal Reserve fund rate and GDP per capita. Well, if I wanted to go through and calculate some sort of a correlation on these, I might go through and highlight these 2 columns and either calculate it based on a formula or use the Data Analysis Toolpack under the Data tab. That Data Analysis Toolpack, if you don't have this over on the far right, could be added through File, Options, scrolling down to Add-ins, Manage Excel Add-ins, and clicking Go, and then you check the Analysis Toolpack. and it should now be available. And there's a lot of great tools under the data analysis toolpack: moving average, correlations, covariance, regressions, etc. And that's all great, and it's very useful for data analysis, but it's not AI. And the difference between this and AI is that artificial intelligence is supposed to identify the relationships for you in advance. Maybe there's a relationship between the Fed funds rate and, say, Canadian GDP that I didn't know about. That's what AI does. Excel has recently added a new tool to help us do this. So if I come to the Home tab and then highlight the columns of interest and click Ideas, Excel's now going to populate a variety of correlations and other variable calculations that it thinks I might be interested in. So it's saying we can go through and add a chart on, say, EWG based on observation dates. We could go through and look at comparisons. It notes outliers in the data that perhaps I should be aware of, and a variety of others. One point that might be very interesting: maybe I didn't realize there was going to be a correlation between this variable, GDP, CTPI, and GERINT, GERINT. So maybe I want to insert that chart, and it shows that there's a clustering in the groups for this particular. And the areas where AI has opportunity to grow are really the same areas that it's been for the last couple of decades. It's just incrementally advancing each of these frontiers, if you will, on its own. So to begin with, we have what we refer to as search. Essentially, AI starts with a large block of information, and it needs to go through and search that information to find the relevant data that lets it respond to a question or query or request. This search aspect encompasses everything from game playing to large language models. How do we respond to queries that come in? So search, the frontier, the opportunity, is really all about making that more efficient over time so that we respond better to queries that come in. Similarly, we've got to deal with how do we represent knowledge or concepts or ideas from this database that we have. We might have, as an example, a set of historical annual reports from companies, including management discussion and analysis. So maybe we're going to ask AI, how should we respond to a recession in our business, and what kinds of approaches have companies taken in the past? Well, the AI tool needs to be able to take that body of knowledge and synthesize that, and then offer useful recommendations based on that. So that's another frontier. Similarly, we have planning and learning. In the context of AI today, we're often referring to machine learning. That is, the machine should, over time, give better and better responses based on user feedback. So we need to be able to upgrade or update our algorithm over time as we get more information coming through. And part of this plays into what we call natural language processing. Most of the time, when we're dealing with an AI system, we don't want to have to type in computer code in order to interact with that AI tool. So the AI needs to understand what we refer to as natural language. That is, we type in a question or a query into ChatGPT or another tool, and it responds back in an appropriate way. All of this starts to play into what we refer to as expert systems. An expert system is simply an AI tool, a GPT that has a specialized purpose, right? And expert systems date back to well before OpenAI or ChatGPT. They were around in the 1990s and even the very late 1980s. But essentially, an expert system just takes a specialized data set and then uses that specialized knowledge to answer particular questions. For example, we might think about this being applied to the legal field or the medical field. We probably shouldn't go and ask ChatGPT to give a medical diagnosis, right? Why? It's not because it lacks the reasoning ability to answer a particular question or identify a particular symptom. Maybe it does, maybe it doesn't. But what it certainly will lack is the appropriate medical database. We need a set of very specific documents pertaining to our particular area, right? Whether that's medicine, the law, investment recommendations, budgeting, business decisions, whatever. We want to have an expert system that has particular knowledge focused on that specific endeavor. Then finally, going a step further, if we want to talk about true artificial intelligence, we might be thinking about how we can interact with that tool in a physical way, right? Through robotics, as an example. So this could mean vision, speech, dealing with a physical robot in a factory or an assembly line or a warehouse, things like that. So artificial intelligence needs to advance not only on the software front, but also on the hardware front as well. Now, this comes from a study done by Ernst & Young, but it's basically just a complex Venn diagram that shows you how different aspects of FinTech are coming together as a whole, right? And But I want to drill down and talk about how this works in practice, and more broadly, the applications and opportunities for quantitative finance based on AI. So I'm going to use ChatGPT, and I've simply come in and I'm going to ask it, straight from the horse's mouth, how does a large language model like ChatGPT work? Well, it's going to tell me, hey, the large language model, like something like ChatGPT, it's going to essentially take an input, a sentence, like the one above, and it's going to break this down into a series of words. We used to call this textual analysis, but it's basically going to take these words and then convert them into a series of cues that the LLM is going to interpret. And based on that, it's going to go through and take essentially the key parts of that input and say, all right, how do I want to respond to this over time, right? These input tokens, the model is going to analyze them and say, based on what those input tokens are, how should we be responding to this? Now, this requires, of course, that we have a very large amount of background information that's been built into the system. Without a large training data set, the LLM wouldn't know what to say. It might be able to go through and recognize, hey, these are certain parts of the sentence, but it wouldn't know how to interpret and use those. So when we're looking at a sentence like this one, how does a large language model work? It wants to identify work and large language model, and it's going to go through and interpret that and say, all right, this is what the user is looking for. Now here's how I need to respond. And the key is we're going to have a set of probability distributions based on the vocabulary that's used. So based on the words that I'm using in the sentence, we have a set of probabilities for how we should respond to these different words, right? Essentially, we ask the same question 100 times. What are 100 different acceptable responses to this? And then how often should each of those responses be used going forward? That's the basic idea. Now, this involves what we refer to as inference. In other words, we're going through and drawing an inference from the model as a whole based on these probabilities, okay? So in order to do this, we've got a process where we're going to pull in from our data set, from our training data set, all of these different appropriate responses to the question at hand, and then we've got to figure out what the probability is that each of these different responses should be used. And there's different ways to do this, right? And I'm not going to go into kind of the statistics behind it, but essentially, we're just looking at a series of different statistical techniques which tell the system as a whole what are the most appropriate responses most of the time based on the words that are used in the query. So the important point is, as much as it seems like the AI tool understands what you're saying and is talking back to you, it's not. At least not in a conventional sense, right? Instead, it's taking the sentence or prompt that you put in and decomposing that into a series of words and then responding back based on mathematical formulas behind the scenes. Now, how does this compare to an older AI technique called an expert system? Expert systems have been around since the 1990s or even the late 1980s, and essentially, the difference here is that LLMs don't have a proscribed set of rules. They're basically doing exactly the same thing, the expert system and the LLM. It's just that the LLM is going to rely on a set of probability distributions, which enables it to be more flexible compared to the expert system. Expert systems have a set of rules that they're following based on kind of pre-envisioned scenarios. So the expert system is not going to be very good at dealing with randomness or reasoning or trying to kind of deal with things on the fly like a human would. But on the other hand, the expert system, because it's rules-based, is much easier to understand what it's doing and why compared to the LLM, which is probabilistic in nature. So in a nutshell, that's how large language models work. Now, large language models, or LLMs, are just one aspect of the growth in AI. As we've already seen, they're not necessarily great at math. And a lot of finance, of course, comes down to mathematical equations. So there's really a big opportunity for artificial intelligence in the future to go through and replicate what humans already do, but quickly and efficiently compared to what we do now. One example of this is in forecasting. So I've got a tool, and, candidly, all cards on the table, this is a tool I'm developing, but essentially it's just using artificial intelligence techniques to make sales forecasts, right? Now, this is still in development. It's a sample tool, but the point is that we can use AI to advance the types of tasks that humans have to do right now. So we've got a set of sales data over time, and then we can go through and feed that into our model and update this based on what we're interested in seeing for a particular scenario, right? So we might be going through and looking at doing Well, in a nutshell, robo-advising is really just using automated and digital techniques to go through and build and manage a portfolio for an investor. Usually this is done with what are called exchange-traded funds. Now, if you're not familiar with ETFs or the investing landscape and you want to learn more, I recommend my Understanding Capital Markets course here on LinkedIn Learning. Essentially, what a robo-advisor does mechanically is fairly simple at this stage. The robo-advisor provides the client with a survey that assesses the client's needs, their risk tolerance, and profiles them in general. From there, the robo-advisor uses that survey and the responses to it to come up with a basic asset allocation. Then, once that asset allocation is implemented, the portfolio gets monitored and adjusted over time based on the client's needs. It gets rebalanced as asset values change, and the client gets reports on its status at various points in time. Now, robo-advising has picked up a tremendous degree of momentum in recent years, largely because it fills a void for millennials. The reality is that other entry-level investment vehicles these days have pretty low returns. CDs, savings accounts, things like that, you really can't earn more than 1, maybe 2% on those. Robo-advising offers millennials a low-cost way, to invest in the markets I've gone through and created a robo-advisor for you here in Excel. Let's go through and see how this process works, shall we? I'm in the 0302 begin Excel file. Now, this is a simple questionnaire, and we're going to go through and just fill this out. And the Excel sheet, the robo-advisor that I've created, will generate a portfolio for us based on these responses. So to begin with, let's just pretend we've got a hypothetical person, all right? And we're going to go through and fill this out for that particular individual. So what's the individual's age? We'll say it's 35 years old. Now, we want to know something about the risk tolerance here. If the portfolio of stocks that the investor has invested in lost half its value, what would that individual do? Would they sell and panic? Would they sell and panic just a little bit? Do nothing and wait it out? Buy more? Or buy everything? Sell their house and buy more stock. We'll say this person's kind of in the middle of the spectrum for risk tolerance. So we'll put in a C. Now, do they want to add international stocks in addition to U.S. stocks? Do you want that diversification, or do you prefer to remain with U.S. stocks? This is really focused on what's called home bias. If you're not familiar with the concept of home bias, I recommend one of the behavioral finance courses here on LinkedIn Learning. I'm going to say, yeah, we want some international stocks. We'll have a moderate level. How about corporate bonds? Do we want to add that level of diversification? Sure, why not? Let's go ahead and put corporate bonds in. Next up, we're going to ask about a behavioral finance phenomenon called factor tilts. And in particular, we're looking at small cap stocks and deep value stocks here. These stocks are riskier in general, but have higher returns. Do we want to tilt towards those? We'll go ahead and say, yes, we do. How strong do we want that tilt? Let's just say an aggressive tilt. Next up, how about REITs? Do we want to have any real estate in the portfolio? It's going to have some negative tax consequences because it generates a lot of income, but again, we'll go ahead and say that our investor is interested in that. Next up, we want to know how much that investor has to invest in the market. Let's just say he's got $250,000. Okay? And in addition, that investor is going to save money every year to put towards this portfolio. We'll pretend that the investor is going to save an additional $10,000 every year going forward. Next, for forecasting purposes, we want to ask about the investor's expectations about the market in the future. Now, stocks have historically returned about 10.5% since 1928. Do we want to use that return as our expectation for the future? Or do we think that returns will be higher than that or lower than that? What's our gut feeling on the economy? Well, maybe we feel like the economy's in a little bit of a tough shape right now, so we foresee lower returns going forward. And then finally, how long until we retire? How long do we have before we want to project our assets? And we'll just say 30 years. Now, we go through and fill out this questionnaire, and I'll scroll back up to the top, and let's just see what the recommended portfolio based on these responses is. If we come over to the recommended portfolio tab, we'll see that the Robo-advisor has gone through and it's put out an allocation that it thinks we should have for each of a variety of different ETFs that we can use in our portfolio, SPY, VBR, etc. And use a survey-based approach to assess what the portfolio should be for a particular investor. But how's that analysis done? Let's take a look. I'm in the 0303 begin Excel file. Now, we've gone through and taken a survey for a hypothetical investor and put in a set of responses. Let's see what that portfolio looks like. So as we see for this particular investor, they have a pretty good set of investment options ranging from U.S. stocks that are non-small value, meaning large and momentum focused, to international stocks, bonds, REITs, and even a little bit of cash. Now, how did we come up with this particular portfolio? Well, the answer is hidden in the Portfolio Calculator tab. So if I come over to the Portfolio Calculator tab, let's see how this process works. So we've taken the investor's answers from the questionnaire on the first page, and then we're going to translate them into numerical content. All right, just to make it a little bit easier for the system to process. From there, we need to go through and we need to determine what the asset allocation should be for this particular investor. That's all going to be based on the parameters that we set in the background of the system. So let's just take age as an example. Our investor is 35 years old. We have an age adjustment factor. Now, unsurprisingly, most financial advisors would tell you that as you get older, you should have more in bonds and less in stocks. So in essence, our parameters for age adjust for that. So if we look at the age adjustment parameter, what we're going to see is that if we have an age category of 1, then we want to add 15% to our stock allocation. If we have an age category of 2, we want to add 5% to our stock allocation. An age category of 3, we take away 5%. And an age category of 4, we take away 15%. How are those categories defined? Well, in our particular case, we've simply used a simple if statement. If the investor is less than 25 years old, age category 1. If they are between 25 and 40, then age category 2. If they are between 40 and 65, age category 3. And if they're over 65, then age category 4. We go through and make similar adjustments based on their level of risk. Notice, the robo-advisor here, the key part is what those parameters are. If we've set those parameters appropriately, then we're going to have a great portfolio. If we fail to set the parameters appropriately, if the programming behind the scenes isn't good, then our portfolio is going to be junk. The system, the algorithm, doesn't really understand the investor. It's just operating on the data we have in the background. Is a plus 15 to minus 15% spread appropriate? Well, it really depends. But this is a good starting point for this particular system. From there, the system goes through and makes similar allocations based on, say, the international exposure the investor is looking for versus the U.S. exposure, whether that investor is looking for small value stocks or whether they want to stick with traditional large caps, the level of bond investment they want, if any, etc. So again, these parameters, there's nothing magical about them. They need to be set by an intelligent human behind the scenes. The point is that even in a world of AI and robo-advising, there's still a role for humans in terms of making sure not only that the programming is technically correct, but that it makes sense and it's consistent with the needs of investors. We change any of these parameters, it'll have a massive impact on all of our users. That's the point. Once the system goes through and allocates to all those particular investment categories, it's going to go through and spit out a percentage allocation, which will add up to 100%, an allocation based on the level of investment for that particular investor, and then a forecast based on the future value function and the time period the investor wants to look ahead. But that's how our basic robo-advisor works. Nothing magical here, right? Just good old-fashioned logical mathematics, along with some financial intuition and financial judgment. One thing that a basic robo-advisor needs to be able to do is not only recommend a portfolio to investors up front, but also be able to tell them how to adjust their portfolio over time. I'm in the 0304 Begin Excel file. Now, this is our recommended portfolio for our hypothetical investor. As the investor ages, that portfolio will change. So later on, when that investor gets to be, say, 50, perhaps they become more risk-averse, as an example, their portfolio should shift based on that. And that's exactly what we see in this particular basic robo-advisor. But not only do investors' needs change as they age, but they're also going to change based on what's happening in the overall market. For instance, maybe we've seen a deterioration in U.S. stocks, as an example. So we want to tilt away from U.S. stocks and towards bonds based on that, or rebalance our portfolio to maintain our asset allocation. Well, the basic Excel sheet that we have here can't easily do that because it's a static tool, right? This is where AI comes in, and this is where a lot of the automation comes in behind the scenes for professional robo-advising firms. Let's take a look at one of those firms now, just to illustrate this point. So I'm here on the Betterment website. Betterment and Wealthfront are There's a variety of alternative investment vehicles that are now available for investors through online portals. To be clear, nothing that I'm about to say in this video is intended as personal investment advice for you or anyone else. Everything I'm going to say is simply intended as educational material. I have no affiliation to any of the companies that we're going to talk about here. With that said, it's useful for you to understand some of the different options that are out there from an investment perspective, simply so that you understand how the landscape is changing. One example of this is Yield Street. Yield Street offers alternative investments for investors through an online portal. And as we see here on the Yield Street page, the investment offerings for Yield Street generally have returns in the 8 to 15% range, according to them, and a 1 to 3 year offering. So what type of investments are they offering? Well, it includes things like commercial real estate, say for investing in retail pharmacies. It includes things like industrial financing, senior homes, litigation finance would be another area, retail portfolios, marine finance, and a variety of others. This is an area of FinTech that's exploding in popularity. Traditionally, these kinds of investments simply weren't available to regular investors out there. Now, you still have to meet certain criteria for Yield Street or many of these other sites, but they do offer you novel investment options and additional diversification that was never available previously. Another example of this type of platform is Realty Shares. So this page, I've logged in after creating a basic account, but this page simply shows us examples of Realty Shares investments. So you could invest through their platform in things like hotels, multifamily apartments, and a variety of other retail and industrial real estate applications. You do all this without ever having to set foot in that particular investment. Realty Shares handles all of this. In some cases, they're equity investments. In other cases, they might be debt investments. It really depends on the funding portal and the real estate company and what they're looking for. I should say the investment company and what they're looking for. But Realty Shares is another instance of this. For those who are more interested in early stage companies, think Uber or Airbnb, theoretically at least, at the very earliest stage, there's a variety of funding portals out there that are intended to try to enable investors to get in on super early stage companies. This type of funding was made possible through the Jobs Act, which was passed earlier this decade, about 8 years ago or so, by Congress, and then the SEC rolled out new rules around it. But basically what Circle Up and their competitors do is go through and offer early stage consumer brand investments to investors. So you could invest in various grocery companies or other makeup companies, as an example, cosmetics, things like that. Sometimes restaurants, things of that nature, based on whatever your particular investment criteria are. Now, as you might expect, and this is probably not going to come as a surprise, all of these types of investments are much riskier than investing in stocks, or certainly let's take a look and try and better understand what goes into the robo-advising process. So, to begin with, robo-advising really starts with a set of 3 important steps: asset allocation, implementation of that portfolio that's been recommended, and then monitoring and rebalancing. Now, we can add kind of more levels or granularity onto this, but at a high level, that's the basic process. Robo-advisors as a whole are generally operating on a passive basis. So they're not picking individual stocks or particular stocks. They're not there offering an opinion on whether Apple or Nvidia or Tesla is a good buy at these levels or things of that nature, right? Instead, they're trying to design a portfolio that captures the broader needs of that investor and addresses those in a big picture, long-term fashion. So this starts with picking asset classes based on the investor's objectives and then the characteristics of those asset classes. And then, having determined the ideal set of asset classes for portfolio construction, the robo-advisor can estimate capital markets assumptions based on each of these different asset classes. This is a process that we call mean variance estimation. But basically, different robo-advisors use different methods to estimate your expected returns. And these expected returns matter, but they matter less than your asset allocation decision. In fact, the biggest driver in your overall portfolio return, the biggest driver for the overall expected return on that portfolio, is not whether you hold Apple or Nvidia. It's not whether you're using the Vanguard or the Schwab S&P 500 ETF. It's instead about what is your allocation to stocks versus bonds versus real estate. It's really all about, over the long run, the level of risk that you're taking on. The more risk you're taking on, that is, the more variation you're willing to accept in the portfolio's value, the greater your long-term returns will be. Now, different robo-advisors are going to recommend different allocations based on their own internal programming, and then, of course, what the investor has told that robo-advisor up front. But once we've settled on what that portfolio should be, next, we've got to have some sort of implementation process. So robo-advisors are going to choose exchange-traded funds for each asset class based on after-tax, risk-adjusted portfolio returns. And they're typically going to select ETFs that have minimal costs, ample market liquidity, and then a minimal tracking error. Now, pragmatically speaking, robo-advisors are also picking from a limited universe of ETFs. They're not going to pick from all the ETFs that are out there. Instead, they're going to pick from the ETF menu or set that has been approved by the robo-advisor firm. So Betterment or Wealthfront or Schwab or whoever the robo-advisor firm is, they have a set of kind of preferred ETFs that are going to go into their menu. And then the robo-advisor will select from that menu for a particular individual based on that individual's needs. Now, why don't we include all ETFs in here? Well, because that is a source of revenue for the robo-advisor firm. We can get payment for what we refer to as shelf space. That is, we can get paid by the ETF provider for allowing them to be included in the menu of available options. Or perhaps we're only offering ETFs that we ourselves sponsor. Somebody like Schwab, they're a big ETF sponsor. They have lots of different ETFs that operate under their umbrella. Maybe we just allow investors to choose from Schwab ETFs. Those are the only ones that are on the menu. The point is that different robo-advisors are going to have different menus, and so you'll come up with different allocations accordingly, right? Now, you'll also see some firms that have moved beyond ETFs, particularly for larger accounts, and they're using what's called direct indexing. And what this means is basically they're going to be replicating particular indices by holding individual stocks that underlie those indices. Essentially, it's back to holding individual securities, but with a broader goal or framework in mind. And then step 3 is we've got to rebalance over time. So if we have 5 different stocks and they were each worth $100 today, the value of our position is $100 in stock A, B, C, D, and E. Well, I promise you that tomorrow they will not all be worth $500. Some might go up, some might go down, but they're going to go up or down in different amounts and different increments, and they're not going to stay the same. And so what was a 20% allocation to each of these 5 stocks yesterday will not be 20% tomorrow. So we're going to have to rebalance that over time. How often do we rebalance? Well, rebalancing is costly. It costs money to trade. Even in the absence of commissions, there's still implicit trading costs, most notably price slippage that can occur. And so as a result, we're going to have kind of a balance between rebalancing so that our portfolio stays anchored to our needs, but at the same time, minimizing those costs over time. Now let's try out this whole process in practice. Let's see what this looks like in a real world context. So I've pulled up Betterment, and we can just kind of see when you're getting started, what does this look like? Well, Betterment's going to tell you, what's your goal? Are you investing for a specific goal? Are you investing to build wealth, investing for retirement? Do you want to invest in crypto? Whatever. And they're then going to go through and ask you a sequence of questions. So it looks a little like a survey, and you're just kind of going through, in essence, this tree, if you will, of different survey options. And that's going to help it pick the portfolio that it thinks is best for you. But let's see how this would differ if we were just trying to do kind of a make-your-own robo-advisor with a Gen AI tool. So I've asked Claude to give me a specific investment portfolio recommendation for a 30-year-old long-term investor, annual income of $75,000, specific ETFs recommendations for each asset class, right? Now notice I haven't said anything about the family situation or goals or anything of the sort, so this is just a high-level framework. But Claude is going to go through and it'll give me an allocation. Domestic stocks, 40%. Here's the 3 allocations, right? And it's focused on the Vanguard Total Stock Market, ETF, VTI. Then it's got 20% to international stocks, 30% to bonds, 5% to real estate, and 5% to commodities. Big picture, all of these look reasonable. We know that Vanguard is a low-cost provider for pretty much all their investment products, so you can be pretty confident that those are reasonable overall, and this allocation is probably a reasonable generic starting point. Okay, fair enough. Now, what kind of expected returns would I be looking at here? And how should I be dealing with kind of updating that portfolio over time? So I'm going to ask Claude. I'm going to start by asking how often the portfolio should be rebalanced. And it says, hey, this is a complex question, but in general, you want to rebalance when the asset allocation drifts significantly from the target or else annually. And it suggests maybe a couple of different options here. And then it's going to get specific for that particular investor. And then how about, what do my long-term returns look like? Now, this is kind of notable. So it says, all right, here's my asset classes: stocks, international stocks, bonds, real estate, commodities. And we'll look at what the returns are. It's got a 7% expected annual return on stocks, 6.5% on international, 3% on bonds, 6% on real estate, 4% on commodities. Now, certainly reasonable minds can differ about what we can expect for assets going forward. Nobody knows with any certainty. And the historical record is going to vary depending on the period in question that you're using. But big picture, I would say these numbers are a little low, right? Maybe X inflation, this is correct, right? US stocks, 7%. That's a little low. X inflation, it's probably close to right. Same thing with bonds, right? After taking out inflation, it's probably 3%. But before inflation, it's going to be generally 5, 6, maybe 7, depending on kind of how much risk we've got. So overall, Claude's going to go through and do this calculation for me. And it says, hey, my expected return overall is 5.6%. My volatility is 11.1. Sharpe ratio 0. online lending and crowdfunded based lending is that there's so much data available with it. So I've gone through and I've pulled some basic data from Lending Club on some of the loans they've made in the past. And we might use this data to go through and understand what are the risk factors that drive delinquency in a loan or charge-offs in a loan. Now notice I pulled a very limited data set for our purposes. We've actually only got 200 loans available at this point, but Lending Club has made tens of thousands of loans. So if you'd like, you can do this exercise on your own. I'm in the 0307 begin Excel file to get us started though. Now, what you'll see here is we've got a loan ID, the loan amount, term, interest rate, the grade on the loan, and a variety of other pieces of information. Some of our information is numerical, like the loan amount. Other pieces of information are decidedly not numerical. They're text in nature. Things like renting or owning your home, the employer that the lender works for, the state that the employee works in, or the borrower works in, I should say, when they've got their first credit line, things like that. We've got a variety of different pieces of data, though. Now, there's two ways to analyze this kind of data. Option number one would be to go and use the data analysis toolpack that's available in Excel. We can get that through the Excel add-ins menu. So we could certainly come through and we could look at a regression analysis in order to understand what the risk factors are in this type of data. And that's a perfectly reasonable way to do it. The only problem with trying to use a regression is that when we get done, Excel is only going to be able to run a regression on numerical data. We'd have to put in, as our Y input, something like the loan status. We want to understand whether loans are going to get fully paid off or whether they are going to be charged off over time. Well, Excel's not going to be able to handle that because it's non-numerical data. A regression doesn't make sense with textual data. So we'd have to go through and change all of these text data lines in order to turn them into numerical form. So we could add a dummy variable here as an example, fully paid, and simply say this value is equal to 1 if the previous column equals fully paid. Otherwise, it's 0. And we could use that for our entire data set. And now we could go through and start to run a regression based on, say, loan amount or things like that. And that's a great option. If you're interested in learning more about how to use regressions for that type of forecasting, I recommend my Financial Forecasting with Big Data course here on LinkedIn Learning. But the attractive thing about new technologies like that being offered by Excel is that we can also use alternative mechanisms to evaluate the risk. So I can come to the Home tab in the newer versions of Excel and click Ideas, and Excel will use an AI algorithm in the background to go through and try and identify different correlations or relationships of interest in my data. So some of this won't be of interest. For instance, annual income by grade. Unsurprisingly, if you're considered a safer borrower, it's probably because you have a higher income, right? So it's not surprising that annual income is higher for safer loans. But we could go through and look at other variables of interest. For instance, outliers in revolving balance across the data. For instance, the fact that grade B loans, high grade loans, are considerably larger than other categories of loans. The loans made admittedly in our very limited data set of only 200 data points, but the loans made to these other loan categories are generally much smaller. So this type of information could all be gleaned from the Ideas tool in Excel. We can take the power of AI and apply it to this data. And notice, even though this is non-numerical data, even though it's text data, for instance, loan grade, Excel still understands how to take that text data and apply it to the numerical data in order to come up with meaningful recommendations. And so it's important that you understand them for the potential they represent for the future. Now, to start with, cryptocurrencies, as the name implies, are designed to act as a currency. In other words, they're supposed to be a medium of exchange to help facilitate commerce. Unlike traditional currencies, though, they're backed by a government, or in the case of the EU and the euro, a quasi-government entity. There is no central authority, no central agency behind most of the cryptocurrencies out there. Moreover, most of these cryptocurrencies have no physical form. Instead, the coins themselves are just an alphanumeric sequence, which gets assigned to essentially an account, a digital wallet. And then that digital wallet is used to keep track of the transfer, the inflow and outflow of those cryptocurrencies. The nice thing about cryptocurrencies from a technical perspective is that unlike traditional currency, cryptocurrencies are nearly impossible to duplicate or counterfeit thanks to the advanced programming behind them. These cryptocurrencies are all stored and recorded using a blockchain, so every transfer involving something like Bitcoin or Ether is tracked over time. But these transactions and transfers are anonymous. Because of the anonymity, unfortunately, cryptocurrencies early on became very enticing for criminals, black market and gray market type transactions. For that reason, they've attracted a lot of regulatory scrutiny, a lot of concern about who is using these cryptocurrencies and why they're using them, at least on the part of government regulators. Most cryptocurrencies do have some sort of a limited number of coins that can be created. So something like Bitcoin, there's a maximum of 21 million Bitcoins that will ever be created, and there are fewer and fewer Bitcoins released each year. So they're inherently deflationary as a result. Now, if you're interested in investing in cryptocurrencies, you first of all need to understand that these are risky assets. There are ETFs out there that are looking at including cryptocurrencies in them, but to date, I'm not aware of any SEC or Securities and Exchange Commission approved ETFs that hold cryptocurrencies. There's a variety of ETFs that have been proposed to the Securities and Exchange Commission, but the SEC has had no interest thus far in approving any of them. My personal experience, given some of my consulting work, is that that's likely to continue going forward. There's just tremendous regulatory When we think about traditional currencies, like the US dollar, it's pretty straightforward, right? We have a market, we have supply and demand that dictates the exchange rate between, say, the US dollar and the British pound. So $1 might be worth 0.66 British pounds, as an example. Well, we don't have to ask what the value of a dollar is in the US. Everyone knows $1 is worth $1. You set the price of products appropriately. The exchange rate dictates international values. When you think about cryptocurrencies, this problem is considerably more complicated. I'm in the 0402 begin Excel file. Now, this file is simply a financial model that I created a few years ago on a consulting assignment with a hedge fund. And the goal was to get some sense for what the value of perhaps the most well-known cryptocurrency, Bitcoin, is. Now, everything I'm going to say here should not be taken as any sort of investment advice. I am not advising you to invest in cryptocurrencies. That is the opposite of what I'm doing. The goal in this video is simply to create educational material that'll help you to understand and know your own valuation for cryptocurrencies so you could decide if these are right for you or not. Now, in order to come up with a valuation in our financial model, I've used 5 different approaches here. Each of these approaches has their own individual value for Bitcoin, and then I've weighted them based on my view about what each of these particular approaches requires from the point of view of an investor. The idea is to weight these based on how credible each approach is and how relevant it is to the overall price of Bitcoin. Now, for 2018, this model was built in 2017, but for 2018 purposes, as an example, we've taken our projected Bitcoin value for each of the 5 categories and then multiplied it by the weight that we assign to it. So if I change any of these weights, let's pretend I no longer feel that the miner's profit, the miner's cost, and the alternative cost approach now deserve a 17.5% weight. Perhaps each of them deserves, say, a 20% weight with a reduction in the wallet value approach weight to, say, 35%. And, well, let's change it to even 30, just make our numbers a little nicer. And then the world wealth approach will be worth, say, 10%. We spit out a value based on the weight times the appropriate valuation from that particular model. So the world wealth approach had a value in 2018 for Bitcoin of $17,461. We multiply that by the 10% weight that we gave that approach. That approach was not considered as accurate as something like the wallet value approach. When we got done with that, we sum up the value across all 5 of these different approaches. And we could do this for the years 2018 through the end of our forecast period, which is 2023. So we take that same approach and we adjust it over time. then we could discount that value back. The 2023 estimate for Bitcoin's value is $70,000. We're going to discount that back to present. In this case, our model is for the year 2018, but we could discount it back to 2019 today. But we discount it at a 31.38% rate, and that gives us a fair value of Bitcoin of $13,522.21. Now, a couple of notes on that. First of all, this should not be taken as an indication this is what Bitcoin's true value is, right? This is simply based on one set of assumptions. The fact that we're using a financial model is also telling, right? Financial models are not new. They've been used in all sorts of asset classes for decades. There's courses right here on LinkedIn on financial modeling that you can take. This is not a new concept. Instead, we're taking the old concept of a financial model and applying it to a decidedly new FinTech technology. The point is that we still, even for something new, a novel investment, if we can call it that, like Bitcoin, still has to be valued somehow. And we need a financial model in order to do that. Is this model the right model? No, absolutely not. There are all sorts of problems that are going to be true of any financial model. The model is just an approximation. The devil is always in the details. We can make any assumptions we want in a financial model, and that'll determine whether that model is accurate or absurd. I'm in the 0403 begin Excel file. Now, this particular model is a model that I created for valuing Bitcoin, and this is from a few years ago, but, the basic principles still hold. Now, if we wanted to understand where we come up with the discounted or projected value of Bitcoin of $9,335, it comes from various assumptions we've made based on 5 different types of valuation approaches: the world wealth approach, the wallet value approach, the mining profit and miner's cost approach, and then the alternative cost or alternative coin approach. All financial models start with some sort of assumptions about where value derives from. Now, normally, when we think about a traditional asset, like a stock or a piece of real estate, it's pretty easy to decide where that value in that asset comes from. It comes from future cash flows. For something like a cryptocurrency, this is a tougher issue. Traditional currencies often rely on the value of the assets that can be purchased with those currencies. With something like Bitcoin or other cryptocurrencies, this is a harder challenge, right? We don't have a defined model that exists and is well accepted. So I used kind of 5 different approaches. The first was the world wealth approach. I looked at the total value of wealth projected over time based on expected growth rates in overall wealth around the entire world. And then I made a projection based on the percent of wealth that might be in Bitcoin over time. Notice, this is based on increasing adoption of Bitcoin with the idea that Bitcoin will become more popular. If we change that assumption, if we no longer believe that Bitcoin will grow in popularity, well, all of a sudden, all of our other metrics are going to be off. So we've assumed that the world wealth will grow at a rate of 3.52%, and that we're going to see an 89% increase annually in conversion of wealth into Bitcoin. The rationale here is just based on the historical conversion of wealth into Bitcoin. In other words, the growth in number of coins over time, essentially, and the value of those coins. Whatever assumptions we want to make, though, and we might adjust these if we wanted to, that's going to drive our valuation. Now notice, the world wealth approach comes up with a very optimistic value. It projects that by 2023, the value of Bitcoin will be almost $500,000 per coin. This was done a few years ago. At the time, the projection was that Bitcoins, based on the world wealth approach, would be worth $32,000, $33,000 per coin. Obviously, as of the late 2019 period, that has not been a correct assumption. And that's okay. Financial models are always going to be an error. The point is to try to make those errors as understandable and forecastable as possible, and make sure we understand the assumptions that go into it. We use a similar approach to calculate value based on the value of the number of wallets out there and the number of coins held in each wallet. And again, we come up in this case with a much more perhaps realistic estimate for 2019 of about $7,300 per Bitcoin in value. Similarly, the miner's profit and miner's cost approach look at the value of Bitcoin based on the cost associated with mining Bitcoins and the profit that those miners make. The idea is that fewer miners results in a change in the supply-demand dynamics for Bitcoin, which in turn will help to balance out Bitcoin's price over time. And we get very different values in 2019 for Bitcoin based on each of these, $10,000 versus $4,000. Finally, the alternative cost approach is based on the cost of electricity and the cost per unit of electricity to produce Bitcoins. And this gives us a value of about $2,900. So one thing that should stand out to you in this model is the vast differences in value under each of these different methodologies. The World Wealth approach came up with a value of about $33,000 on the high end, where the alternative cost approach came up with a value of $2,900. That might sound silly, but the reality is that financial models often have that level of variation in them, even for well-understood assets like stocks. It's common to value a stock based on cash flows over time or based on the sum of parts of a company. And then you have to weight the end value of the stock based on your expectation of which is more reasonable, a sum of parts assumption or a discounted cash flow or cash forecasting approach. So this is not a new problem. All financial models also rely on background data. In our case, we might look at GDP growth, the known mining schedule of Bitcoins, or the number of wallets in existence for Bitcoins over time, and the relative value of various coins in those wallets. Again, the point here is not that this financial model is the gospel truth or that you should be trying to trade Bitcoin on it. You shouldn't. The point was to set up an exercise that helps you to understand how we might apply a concept like financial modeling to a FinTech asset like cryptocurrencies. Now you should have a better understanding of how we can go about doing this and the value of financial modeling and thinking carefully about our financial model in order to understand the value of an esoteric asset like Bitcoin. The point of financial models is not to just build them for fun, right? Unless, of course, you're at the world's most boring Christmas party, right? Instead, the point of a financial model is to give us meaningful insight that we can use for trading purposes. The same thing holds true in cryptocurrency landscape. I'm in the 0404 begin Excel file. Now let's pretend that we've toyed with this financial model and we're happy with the assumptions that we've made. So we've come up with a 2019 value for Bitcoin of $8,600. And based on our discount rate, we think that the ultimate value of Bitcoin is about $11,500. Well, one thing we may want to do is turn to algorithmic trading to enable us to capitalize on this type of a model. Our goal here would be to buy or sell Bitcoin based on our expected value of Bitcoin, in this case $8,600, versus where Bitcoin is trading at present. So how can we do that? Well, there's a couple options. Option number one is to turn to an exchange like Coinbase. Now, there's many different exchanges out there that would let us trade cryptocurrencies. Coinbase just happens to be one of the largest and most well-known. And as you can see, you'd have to go through and after you reach the Coinbase website, sign up for an account and go from there. But Coinbase gives us the ability to buy or sell most of the major cryptocurrencies out there. Of course, Bitcoin, but also Ethereum, Bitcoin Cash, Litecoin, and a variety of other cryptocurrencies that are out there. Coinbase, again, probably one of the best-known exchanges. This is not a recommendation for them. There are many other fine exchanges as well. The only problem with this approach is that if we're trying to trade based on a financial model, it's a lot of work to go through and make trades in Bitcoin all the time. Most of us aren't professional traders, and we're certainly not professional cryptocurrency traders, so we may not want to be sitting here at our computer all day trying to trade Bitcoin's price based on some sort of financial model that we've developed. So the alternative is to turn to algorithmic trading. If you're not familiar with algorithmic trading, again, there's a couple of courses on it here on LinkedIn Learning. But algorithmic trading essentially just takes a computer program and has the computer program do the trading for us. One great tool to start doing this is through QuantConnect, quantconnect.com. QuantConnect lets us go through and develop an algorithm based on our own financial model and based on relatively simple coding principles, and then apply that model to a variety of asset classes. cryptocurrencies have really gone mainstream. 5 years ago, or certainly 10 years ago, you had very little in the way of mainstream financial attention to cryptocurrencies. That's all shifted. So now, as an example, if you want to get prices or returns data, or you want to hear commentary about what's going on cryptocurrencies, well, you can look at mainstream financial sources like, say, CNBC. For instance, right? CNBC traditionally focused on stocks. Today, they have a whole tab on their website dedicated to cryptocurrencies, and we could click on any of these to kind of see what's going on in major cryptocurrency markets. And there's many other resources that we can kind of dig a little deeper on. Now, of course, there's still lots of specific crypto websites out there, right? Like CoinDesk, they're focused on crypto assets as a whole. You want to be careful when using any of these kind of more niche sites because, while some very well-known sites like CoinDesk are certainly reasonable to use, there's also a lot of less reputable players in the space. Still, if you want to understand what's going on in the crypto landscape, perhaps the best place to go is still to one of the major exchanges, like Coinbase. So I'm here on Coinbase.com, and if you click under the Explore tab and come down to crypto, we can see what's happening in the crypto markets. And we'll see that at this particular point in time, for example, Coinbase lists 11,343 different assets. Now, that's really just another word for all of the different crypto assets or digital assets or crypto coins, whatever term you want to use, that are out there. So over 11,000. Now, that sounds like a lot, but what happens if we narrow this universe down to those that are actually tradable, where there are actual trades going on, you could buy and sell this with some degree of liquidity? Well, now we see that there's only 249 of them, right? We've gone from 11,000 different assets to 249 assets. And you can see if we kind of go through and sort this, for example, looking at market capitalization, the vast majority of the coins really don't have enough volume to be worth considering if you're any sort of investor, even a speculative investor. It really wouldn't be worth considering a coin that's not going to trade. It's literally a lottery ticket, right? So the large majority of the market capitalization is still tied up in Bitcoin. Total market capitalization there is 1.2 trillion. Ether or Ethereum, 360 billion, Tether, 111 billion, Solana, 65 billion. Solana is really the one that came out of nowhere in the last 5 years. But we've got a few others, but you pretty quickly see when you go from Bitcoin down to, say, the number 10 spot, well, it's 3 orders of magnitude different in terms of the market capitalization, right? We go from Bitcoin down to, say, Cardano or Shiba Inu, we're talking about maybe a $10 billion to $20 billion market capitalization. And the level of volume in what's actually traded goes from 25 billion down to around 400 million. So there's a big difference in terms of the assets that you're trading. And you've got to be very careful about this. Now, candidly, virtually all digital assets are still very, very speculative. You want to only be trading on that basis, understanding that the intrinsic value here is quite questionable. And we talked about kind of modeling this in other areas. But even for the biggest assets like Bitcoin, you can see that there's tremendous volatility in prices, right? A year ago, when this was recorded, Bitcoin was trading around 30,000. At this point, it's up to about 62,000, having been as high as roughly 75,000. And we could see kind of what's happened over a longer period of time, right? If we look back, say, 10 years, you find that prices have spiked to 65,000 before and then come back down to 30,000. They've spiked back up, etc. Now, depending on kind of your long-term views on digital assets, it could be that Bitcoin still has tremendous growth ahead of it, or it could be that it's going to remain a high It's really just a 21st century version of a very old business tool, the accounting ledger. And as such, it has the opportunity to be used far more broadly than just things like Bitcoin. So let's take a look at how this process works and what's behind the blockchain. Blockchain essentially is made up of 4 individual constituent parts. To begin with, all blockchains start with a basic shared ledger. What this essentially means is that we've got an accounting record of a particular asset and its movement over time between different parties. And this accounting record, this ledger, if you will, is shared in a common form amongst all the different parties that have access to the asset. We add to this, in order to keep the record secure, we add to this a form of cryptography. So in the case of something like Bitcoin, it's a public and private key. But there's a variety of different cryptographic forms that we can use here, but we've got to have some sort of a method to keep that shared ledger authentic and stop fictional or counterfeit transactions from being added to it. Then, because this is shared across multiple parties, we have to add in a consensus element. That is, we have to have a way to reconcile across different parties and resolve any disputes, or more precisely, resolve any inconsistencies or discrepancies in the record between different parties. So again, there's a variety of different mechanisms we can use to do this, but we need a consensus element. And then the fourth piece, and this is optional, but more complex blockchains can add in what's called a shared contract. This essentially means rather than just having, say, numbers representing assets being moved from one party to another, maybe we're adding in additional incremental information that gives us some context for those numbers. For example, the concept behind these smart contracts lets blockchain move to being a platform for assets as opposed to just an accounting system for cryptocurrencies. What I mean by that is we now have the ability to keep track of not only what assets are being moved and in what quantities, but why those assets are being moved, right? Bills of sale, records around what's being done in exchange for the movement of certain assets, things like that. That's the idea behind the smart contract. Now, the term smart contract has become something of a catch-all, but there's three main competing areas that you want to be familiar with. Number one is the vending machine smart contract, if you will. This basically says that, look, the software is going to engage after it receives some sort of external input, like the movement of cryptocurrency, or it's going to send a signal that triggers a blockchain activity. Like, for instance, we receive a shipment, and then the software automatically knows once that shipment has been received and logged as received that it should send payment to one of our vendors. The second form of contract is what's called a smart legal contract. And this is basically a more complex contract, but it's kind of a standard meeting of the minds agreement covering whatever the different parties have agreed to. It could be a mix of different aspects of a written agreement, or it could include things like timestamps, tokens, any auditing, various documentation to prove that a particular transaction has been executed in the proper format, things like that. But smart legal contracts add kind of a layer of complexity. And then third and finally, we have what we might refer to as Ethereum smart contracts, right? So as the name implies, this is built on the Ethereum platform, but there's lots of copycat tools out there these days. But the idea is that the program is controlling different blocks often mathematically defined, and then the data that allowed decisions to be made based on those rules. Now, coming up with the rules varies depending on what you're trying to do and how you're trying to do it. But the data is going to be a very, very important part of any AI system. So where can you get data that might be used in a financial artificial intelligence engine? Well, there's a few different options, but two of my favorites are Words for the Wharton Research Data Services and NASDAQ's Data Link. And I want to talk about each of these briefly. So Words comes from the University of Pennsylvania and their Wharton group. And basically, both Words and NASDAQ Data Link, they're not providing all of the data. They're not gathering it, is what I mean. They're instead more like a data supermarket, if you will. They aggregate the data, and then they sell customers access to those data products that they want. So just taking a look at Words, for example, if you were to subscribe, you come in and you start seeing different subscriptions for different products you have. And these might be based on things like options that you're interested in, or, one of the most popular data sets is CRSP. This stands for the Center for Research on Securities Prices. And basically this takes prices on stocks, bonds, things like that. Okay. But we have CRSP, we have CompuStat, we have a variety of different data sets that are available. So these data sets, again, you select what you're interested in based on your particular use case. And I'll just go into CRSP for a moment. And we'll see as an example with CRSP, basically you can pull information about stocks, index funds, things like that for a long period of time. You can do this on a quarterly basis, a daily basis, kind of whatever you're looking for. That's one example of the type of data that you can get. But of course, the key is you have to pull that data and then merge it together. If we have data on stock prices and we're trying to make decisions about trading stocks based on, say, what's happening to the unemployment rate, to make an easy example, well, I've got to merge up unemployment data with stock data, and you're not likely to find a single database that has both of those in a cleaned up fashion for you. Now, words is great if you're trying to do kind of longer term artificial intelligence rules. So you're looking at a long series of data over time, and then you're making decisions based on that. But if you want to make kind of real-time data decisions, you're building an AI system that's going to react in real time, you're probably going to need something like NASDAQ's data link. Now, most people know NASDAQ as, a stock market, like the NYSE or ICE more pragmatically, Intercontinental Exchange. But NASDAQ has really evolved beyond that and has become a big software provider, a big data provider, I should say. And essentially, NASDAQ Data Link is providing dozens of different data sets that are available for client use to help clients go through and build AI-driven systems. And so we can go through and kind of look at what those different systems are that are available. Now notice, again, NASDAQ publishes some of these, like they've got retail trader activity tracking, as an example, or they've got the NASDAQ eVestment Market Lens database. But then there's also data sets that are provided by third-party groups. So if we were to come down as an example, we've got end-of-day stock prices from Quote Media, we've got data from Zacks investment research providers, Mergent, and a variety of others. But what's interesting about the NASDAQ Data Link is they not only have your core financial data, they also have alternative financial data from a variety of different providers and a variety of different sectors. Next, we have Quandl. Quandl is one example of one of the data publishers with the NASDAQ Data Link. Quandl I first became familiar with through their API tools, but basically they have a variety of different data points that they publish, and this allows users to go through and get real-time or near real-time insights into the markets and then capitalize on those for algorithms and AI-type tools. Now, this is just one example, and there's many other examples in the NASDAQ Data Link, but this gives you a broader perspective on some of the different data sources that are available and how you can use them in AI tools. When it comes to building AI tools in the financial markets or using artificial intelligence in the financial markets, you're going to run into a somewhat unique problem. The financial markets, the data there has a lot of noise in it. What I mean by that is that there's a tremendous amount of variation in the data that's not related to any kind of fundamental or important changes. We don't see this in most other data sets. For example, we don't have the temperature outside on most days fluctuating wildly. If we look at what the temperature is right now, for example, outside, wherever you are, 5 minutes later, it might be 1 or 2 degrees warmer at most, but it's not going to be 5 or 10 degrees warmer or cooler unless there's something very, very strange going on. Whereas with financial markets, we can have stock that is down 2%, and then a few minutes later, it's up 2%. Not for any particularly good reason, but because of market shifts or simply because of randomness in the market. So to separate out that signal from noise, as we put it, we typically have to turn to using advanced statistical techniques. Now, there's a variety of different software packages that you can use to do this, but I'm going to highlight a few of them here for you, right? And these are Stata, SAS, SPSS, and R. And we'll just talk about these briefly. Now, R is open source, which means, in a nutshell, it's free. Because it's free, it's also, in my opinion, less user-friendly than the other products, right? It's something that was created kind of as an open source project, and so you sort of have to be plugged into that product pretty effectively to really understand how to use it and get its full power. But it is a great option if you have a strong technical background and you want to get started with something, you don't want to spend a lot of money, or you're limited on your budget. So R is a great choice in that case. SPSS from IBM is a very popular choice. As the name implies, it's owned by IBM, and so it is a paid product. As you can see, it costs about $100 a month, although that varies depending on seat licenses and things like that. But SPSS is a pretty popular statistical software package. It's used in a lot of these kinds of efforts to understand and develop AI models. Similarly, and probably the most powerful of all of these tools, in my humble opinion, is SAS. SAS is pretty expensive, but it is a great software package if you're looking to do work with large amounts of data, right? When I've done projects involving, say, 5 million or more data points, SAS is my go-to software. SAS is complex. It requires that you learn a little bit of programming. It's not as bad as, say, learning a programming language altogether, but it's definitely not something that you're going to sit down having never used it before and you'll be ready to go in an afternoon. Like, you'll probably need to read some books and learn a little bit in order to get going. But it is a popular and useful software tool if you want to do advanced work in certain industries, in particular the financial industry. If you're looking for something that's a little bit easier to kind of get started with and you're willing to spend a little bit of money, not too much, but a little bit, I personally recommend Stata. This is the product that I would recommend for somebody that was looking to kind of get started in this area. It's reasonably cost effective and it's reasonably user friendly. Again, it's not like Excel where you're going to sit down and just immediately be able to use it, but it's a paid product, so it's got pretty good support that's out there. There's a lot of information and resources online, and it's reasonably user-friendly. So let's take a look at Stata and just briefly how you might use it. Okay, so I'm looking at Stata, and basically in Stata, you have kind of this main window where you type in whatever you're trying to do, right? You type in your code. And so, for example, if we wanted to run a regression or something similar, you'd type reg and then whatever you're trying to regress. So as an example, just making something up, maybe I'd be trying to regress the excess return in the market on certain beta metrics and different factors. And this regression is kind of nonsensical, but I'm just plopping something in to illustrate how it works. So I type that in, and it fires out my regression output. Now, this is important because when it comes to the signal and the noise in data, what you're going to end up doing is using statistical techniques to, in essence, quantify what level of movement do we have to see in order for a move to be statistically significant, in order for it to be more than just random noise. And this isn't unique to the financial markets. That idea of kind of filtering out noise, that's been with us for decades, right? It's a fundamental core tenet in, say, quality control, part of industrial engineering. If we're doing a quality control inspection, how do we make sure that our engines, as an example, don't have a fundamental defect? Well, we do testing on certain products that come off the assembly line. And if we find a statistically significant number of defects, we know we've got an issue and we've got to shut down production. Rarely been as much excitement around it as there is today. This figure from a Deloitte Technologies report that was put out in 2021 kind of shows where AI stands today and what might happen in the future. So decades ago, as an example, we had artificial tools, calculators essentially, that would let us go through and do basic mathematical calculations. From there, we went on to develop databases and then eventually to develop tools that would allow us to do basic descriptive analytics, things like means, medians, standard deviations. That all took place, say, in the 1990s. Once we got into the 2000s, and certainly the 2010s, we started to get more and more advanced predictive analytics tools, things that we could use for forecasting and, different tasks of that nature. What's changed today, however, is that we have what Deloitte refers to as cognitive automation. Now, I'm not sure that I would go quite that far, but essentially what the generative AI tools of today do, as we've already seen, is apply statistical modeling to figure out how to talk to humans in a natural language context. Now, the computer doesn't really understand anything. It's just applying a mathematical approach based on data in the background. So it's not necessarily intelligent or even close to self-aware, but having a computer that can go through and apply statistics to build a semblance of intelligence is certainly useful. And so there's lots of different applications we can talk about. And KPMG did a study looking at specifically generative AI and how this might be used going forward in finance. And they highlight that, CFOs in the financial industry are one area where there's a lot of opportunity for artificial intelligence moving forward. Things like forecasting, budgeting, and reporting, for instance. Artificial intelligence has a tremendous amount of potential. Now, if you've been watching this course, though, you might step back and say, well, wait a minute, maybe I've used generative AI tools like ChatGPT or Anthropic or, the Claude model that is in Anthropic or, a Copilot or anything of the sort. And what I've found overwhelmingly, and what we've seen in this course, is they're pretty terrible at even basic math, let alone more complex forecasts over time. So we're clearly not quite there yet, but this is an area where there's a lot of work being done and a lot of opportunity going forward. And certainly we can all agree that in virtually any financial role, there's oftentimes a lot of tedious behind the scenes reporting and record keeping and things of that nature. Whether it's as an example for, say, a financial advisor reporting on what they discussed with a client on a call and then making notes of that, or whether it's monthly or quarterly close for a business, or any other number of different mundane reporting requirements that have to be done. So to the extent that AI could simplify some of that, there's a lot of opportunity. KPMG goes on to say that AI can be used to generate strategic insights. And again, I think this is true to a degree, but you have to remember that AI doesn't have any original thought processes. The artificial intelligence is only as good as its background data. So if you have a corpus of useful background data for the artificial intelligence system to go through and kind of generate responses based on, then sure, it could generate strategic insights. For example, if we had a set of speeches or documents related to strategy for business or things like that, well, a generative AI tool could go through and kind of parse through that and say, here are things that might be relevant to the current business context based on this past information. But in the absence of that underlying inference data, the tool can't necessarily help you. So we want to be aware of the opportunity, but also the limitations that are in place here. There's also a variety of different anomalies that come up in finance, right? In particular around fraud. We have to be concerned about everything from, as an example, fake checks to maybe fraudulent wire transfers and things like that. Artificial intelligence is great at sorting through reams of data, and based on certain rules, it could go through and flag outliers, and it could go through and update those rules as fraudsters change their approach. So certainly there's a lot of potential there on the security side in finance, if you will. But as KPMG highlights, there's a lot of implementation issues. There's a few things I'd like you to keep in mind going forward. First of all, remember the limits on artificial intelligence. There's no doubt that AI is useful and disruptive, but it's only as good as the data and the programming that power those AI tools. There's nothing magical or mystical about it. Second, we think about robo-advising. Remember that robo-advising is certainly an efficient way to build a portfolio, and it's great in that it helps us avoid behavioral biases. But it is just a tool, and we need to keep those limitations in mind. Third, online lending and alternative assets have democratized finance in a new way. Thanks to the Jobs Act and the advent of other FinTech technologies, investors now have a variety of investment options they never had before. Fourth, cryptocurrency is certainly risky, but it is full of potential for the future, and so it's a good idea to keep an eye on that area going forward. So think about all these areas, and if there's some way that they can help you in your day job or in your portfolio. And of course, keep an eye out for other great courses on these topics right here on LinkedIn Learning. I'll see you next time.